Welcome back to Self-Invested. I'm Lemuel, and in today's video we're going to be discussing mortgages for first-time buyers. The topics we're going to be covering are how much you can borrow with a mortgage, what deposit you need, mortgage length and repayments, the different types of mortgages available to you, and finding a broker and applying for a mortgage. Now, before I get into this video, I just want to say one of the best things you can do in the house buying process is to find a mortgage broker. This is because they can explain the whole mortgage application process to you and house buying process to you and give you a good idea of what you're likely to be able to afford. They'll do this by looking through your finances, seeing how much you earn, what your outgoings are, and help you sort of gauge what's comfortably within your budget and what you could do at a stretch, what you could afford at a stretch. Also, if you're buying with somebody like I was buying with my partner, who's now my wife, if there's any sort of disagreements between the two of you, they can act as an independent, knowledgeable sort of advisor, sort of listening to both sides. So, for example, my wife and I had different ideas about how much deposit we should put down and also what type of mortgage we should even have. And by having somebody that's independent, that knows their stuff, they can listen to both sides of the story or both cases and sort of help you make a decision about which decision will be best for you. But we'll talk more about finding a broker when we get to that last topic. So, how much money can you borrow with a mortgage? Well, the most you can usually borrow is capped at 4.5 times your salary. So if you earn £30,000 a year before tax, this means the maximum you'll be able to borrow is £135,000. If you're buying with a partner, however, and they earn £30,000 as well, you'll be able to borrow 4.5 times your combined salaries. So in that example, you'd be able to borrow up to £270,000. However, mortgage lenders don't only look at your salary, they also look at different forms of income, such as commission, bonuses, any financial support you may be getting from ex-partners or spouses, and any part-time work or side hustles you might have. They'll look at all the income that you have and make a judgment on what they would include as income and use against that 4.5 times calculation. However, how much your mortgage lender actually lends you is not solely dependent on how much income you bring in. They also look at how much you spend on a monthly basis. So they'll look at your bills, how regularly you eat out, how much you sort of spend on these different things, and try to sort of make a judgment about how much you can afford to repay every month. So if you plan to apply for a mortgage in the near future, it's a good idea to try and rein in your spending and reduce your bills where you can. So how much deposit do you need when buying a house? And how much deposit do you need for a mortgage? Well, before 2008, before the economic downturn in 2008, you were able to get mortgages without any deposit. But since then, it's all changed, and you need at least 5% deposit in order to secure a mortgage and buy a property. If you're buying a property for £280,000, you would need a minimum deposit of £14,000. The bigger the deposit you put up, however, the better the interest rate you get on a mortgage. Just to illustrate this point, I did a search on Money Saving Expert just to see how the mortgage interest rate will change with different deposit levels. So let's see how much it would cost to take out a mortgage of £266,000 for a property valued at £280,000. In this example, you would need a deposit of £14,000. So according to the Money Saving Expert website, the lowest interest rate you would be able to get on a mortgage at the time of this video, which is July 2020, is 2.85%, which is equal to a monthly repayment of £1,241. However, if you were to put up a deposit of 10%, which is equal to 28,000, this would mean you would need a mortgage of 252,000, and the lowest interest rate you'd be able to get is 2.19%, which is equal to a monthly repayment of £1,092. So those examples show the benefits of putting down a bigger deposit. The bigger the deposit you put down, the smaller the mortgage you need and the better interest rate that you get. So one of the best things you can do to save for a deposit is to open up a lifetime ISA if you haven't already, or if you don't have a Help to Buy ISA. Now, the lifetime ISA has replaced the Help to Buy ISA in a way, but it works differently. Anyone can open a lifetime ISA between the ages of 18 and 40. However, it's not only for buying your first property, it can also be used for retirement. And you're allowed to save up to £4,000 every financial year. For any money that you save in a lifetime ISA, the government will give you a bonus of 25%. So if you had £8,000 saved up in a lifetime ISA, for example, the government would give you £2,000 additional bonus to your savings, giving you a total of £10,000 in your account. If you're buying with a partner, you can both take out lifetime ISAs. So they could also have £8,000 in their lifetime ISA and get a £2,000 bonus from the government as well, and a total amount of £10,000 in their account. So together you would have £20,000 in your accounts, £4,000 of which was given to you as a bonus from the government. The key thing to remember about a lifetime ISA, however, is that if you withdraw any money for any purpose other than retiring or buying your first property, you'll face a 25% penalty charge. This means that any money you take out will be less than the money you put in. So to illustrate this example, say you had £1,000 saved in your lifetime ISA. This means the government would give you a 25% bonus, which is equal to £250, and means that you would have £1,250 in your account. If you try to take that money out of your lifetime ISA, you would face a 25% penalty charge, which is equal to £312.50. This means it would leave you with £937.50 after the deduction, which is less than the £1,000 that you put in the account. However, until April 2021, the government has reduced the penalty to 20% because of the COVID-19 crisis that we're in. So any money that you take out before April 2021 will only be penalised by 20%. So with the example I just gave, this means that £250 will be deducted from the amount that you withdraw, and you'll be left with £1,000, which is the same amount that you put in. So in effect, there's no penalty. Another option available to first-time buyers to help them save a deposit is the Help to Buy loan. So the Help to Buy loan is an equity loan from the government where they will loan you up to 20% of the property you buy and its value. So with the example that we gave before, the property worth £280,000, they would lend you up to £56,000. However, you would still need the minimum deposit of 5%. So you would still need that £14,000 in order to secure a Help to Buy loan. So there are a few key things to remember about a Help to Buy loan. You can only use a Help to Buy loan with a new build property worth £400,000 outside London and £600,000 inside London. The second thing to remember with a Help to Buy loan is that when you make payments on the loan, they won't be repayments, they'll just be interest. So the amount that you owe the government won't change. You'll still owe them 20% or whatever percent of your property's value until you actually make a repayment. the interest payments that you're making are just going towards the interest on the loan. They're not actually going towards reducing the loan. Another key thing to remember about a Help to Buy loan is that although it's interest free for the first 5 years, after that the interest rate is 1.75%, and then it rises in line with inflation using the retail price index plus 1%. So that means that the amount that you're paying back can very quickly rise, and it makes sense if you take out this loan to pay it back as quickly as possible, if possible within the initial 5-year period. The last thing to remember about a Help to Buy loan is that it's an equity loan. It's not a fixed amount loan. So the amount that you have to repay is not going to be the same as the amount that you took out, or it's very likely that it won't be the same as the amount that you took out. With the example that we gave with the property worth £280,000, with a Help to Buy loan of 20%, the loan amount that you get in your bank account would be £56,000, which you would use to buy your property. However, when you come to sell that property, and if you decide to pay back that loan, and your property has risen in value to £300,000, the amount that you'll need to pay back is 20% of that £300,000, which means you have to pay back £60,000 compared to the £56,000 that you initially received from the government. This means that the amount you're repaying has increased by £4,000, which doesn't even include interest. So the next topic I'm going to discuss in this video is mortgage length and the impact it has on repayments. So when applying for a mortgage, you'll need to decide what mortgage length you go for. And the mortgage length is basically the period over which you repay the amount that you borrowed. So the shortest length first-time buyers typically go for is 25 years, and the longest period available to you is 40 years. However, from my research, I found that any mortgage length over 33 years tends to push up the interest rate. So, for example, if you were applying for a mortgage of £266,000 for a property worth £280,000 over 30 years, according to the Money Saving Expert website, the lowest interest rate you could get is 2.85%. However, if you applied for the same mortgage amount over 35 years, the cheapest rate you could get is 3.19%. So why would you apply for a mortgage with a longer repayment term? Well, typically, if you apply for a mortgage under 33 years, the interest rate doesn't increase compared with 25 years, and the amount that you would pay back monthly will be lower. So to illustrate this point, if you apply for a 25-year mortgage for the same amount and property value, the interest rate would be 2.85%, which is equal to a monthly repayment of £1,241. However, if you increase the term to 30 years, the interest rate will stay the same at 2.85%, but the monthly repayments would fall to £1,100. The key point to remember about increasing the mortgage period length, however, is that the longer the period you're repaying a mortgage, the more interest you're going to be repaying over the life of the mortgage. So with the 25-year mortgage, for example, over the full life of the mortgage, you'd be paying back £106,323. However, with a 30-year mortgage, the total interest you'd pay over the life of the mortgage would be £130,147, which is £23,824 more expensive. This shouldn't put you off getting a longer period mortgage if it would make your repayments more manageable and the amounts that you'll be paying each month are already close to the most that you can afford. So it's just about choosing a mortgage length which works best for you. If the amount that you're paying back each month is very comfortable, then you can go with a 25-year mortgage and pay it off quicker. When you come to sort of move to another property, you would have paid back more of the loan than with a longer period mortgage. So you would have more equity in the property and be able to use that when you're trying to buy a new property. However, if you're not able to do that, don't beat yourself up about it. My wife and I went with a 30-year mortgage, and you can always decide later down the line when you're in a better financial position to actually take out a shorter mortgage and catch up with repayments. So the next topic I'm going to speak on in this video is the different types of mortgages. So when you apply for a mortgage, you'll need to decide what type of mortgage you go for. Now, there are three main types of mortgages. The first is known as fixed, the second known as tracker, and the third known as discounted variable. The difference between these three mortgages is on how they calculate their interest rate. With a fixed rate mortgage, for example, the interest rate you repay is fixed from the outset. Now, this is usually fixed for a period of 2 to 10 years. The longer the period is fixed for, usually the higher the interest rate is. The benefits of this type of mortgage is that you know how much you're going to pay each month. It's not going to rise. If the Bank of England's interest rate rises, which interest rates are usually linked to, then the amount you pay on your mortgage is not going to rise. The disadvantage with this type of mortgage, however, is if the Bank of England's base rate was to be lowered, you won't see any benefit in the amount that you're paying. Your interest rate will stay fixed. Also, another disadvantage of a fixed rate mortgage is that there tends to be an early repayment charge on any overpayments over 10%. So typically with a fixed rate mortgage, you can overpay your mortgage by 10% each year without being penalized. But if you pay more than that 10%, you would have to pay an early repayment charge. People that would have a problem with this is people that were trying to move before the end of their fixed term period on their mortgage, because if they were unable to port or move their existing mortgage to the new property, they would have to pay back their mortgage in full. And if they did that, they would be penalized for doing so. The second type of mortgage, known as a tracker, has its interest rate linked to the Bank of England's interest rate. So, for example, you may get a tracker mortgage with a rate of 1% above the Bank of England's base rate. So currently, the Bank of England's base rate is 0.1%. If you had a tracker mortgage with an interest rate 1% above that, that means the interest rate on your mortgage would be 1.1%. Now, you can get a tracker mortgage for between 2 to 10 years as well. The longer the tracker rate is set, the higher that interest rate is going to be above the baseline. A benefit of a tracker rate mortgage is that if the Bank of England's base rate reduces, so will your interest rate, and so will the amount that you're paying each month. For example, my wife and I have a tracker mortgage, and we benefited from the Bank of England's interest rate being lowered from 0.5% to 0.25%, then again to 0.1%. That meant that we paid, I think it was around £80 or so less a month. Another benefit of a tracker rate mortgage is that there tends not to be an early repayment charge on overpayments. So with a tracker rate mortgage, if I won the lottery tomorrow, I'd be able to pay off our mortgage in full, and I wouldn't be charged any additional amount because there's no early repayment charge. Or if I was moving to a new property during the tracker rate mortgage period, I wouldn't be penalized for paying back my mortgage in full to take out a new mortgage for the new property. A disadvantage with a tracker rate mortgage, however, is that if the Bank of England's interest rate does rise, then so will the amount you pay each month. So, for example, with my tracker rate mortgage, if the Bank of England's interest rate was to rise back up to 0.5%, this means I'll be paying back around £80 more a month. The third type of mortgage available to you is known as a discounted variable mortgage, which is similar to a tracker rate mortgage, but instead of the Bank of England's base rate, it's linked to your lender's standard variable interest rate. Now, the standard variable interest rate of your lender is determined by the Bank of England's interest rate, but it's also determined by the internal costs of the lender. So it can move up and down independent of the Bank of England's interest rate. So with a discounted variable rate mortgage, the amount that you pay is usually a certain percentage below the standard variable interest rate of your lender. So if your lender's interest rate was 4.09% and you had a discounted variable interest rate of 2% below that, that means the interest rate on your mortgage would be 2.09%. Now, you can typically get discounted variable mortgages from between 2 and 5 years. The advantage of a discounted variable mortgage is that if your lender's internal standard variable interest rate goes down, so will your mortgage rate, and so will the amount that you're paying each month. Also, with a discounted variable rate mortgage, the early repayment charge tends to be lower than what you get with a fixed rate mortgage. There still does tend to be an early repayment charge, but it won't be as expensive as a fixed rate mortgage typically. The disadvantage of a discounted variable rate mortgage, however, is that the interest rate that you pay, the interest rate that your mortgage is linked to, could increase even if the Bank of England's interest rate doesn't increase. This is because the standard variable rate of your lender is not only linked to the Bank of England's interest rate, it's also linked to the internal costs of your lender. So if the lender feels the need to increase its standard variable interest rate because costs have increased, then your mortgage interest rate will increase, and so will the amount that you pay without any other external factor. So which type of mortgage is best for you? Well, this depends on your circumstances. If you're in a position where the monthly repayments are going to be close to the limit of what you can afford, getting a fixed rate mortgage will probably be the best idea. This because you'll have certainty over the fixed term period how much you'll be repaying, and you won't have any surprises if there were changes in the Bank of England's interest rate. I think now would be a good time to lock in a fixed term mortgage because the Bank of England's interest rate is 0.1% and it can't get much lower. So I think you'll be able to get the best deals on mortgages right now that you've been able to get for years. And I think the Bank of England's interest rate can only really go in one direction. There's only 0.1% more it can go before it's 0%. So in reality, it's more likely going to go up rather than down. So if possible, and if it's best suited to you, then going for a fixed rate mortgage might be a good idea. However, if you're likely to want to overpay on your mortgage and your repayments are quite comfortable for you to meet each month, then you might choose to go for a tracker rate mortgage because there tends to be no early repayment charge with tracker rate mortgages. It may also be a good idea to go for a tracker rate mortgage if there's a good chance within your mortgage term you may need to move. Key thing to remember about the type of mortgage you take out is that nobody has a crystal ball. So you may choose to go for a mortgage which turns out to be more expensive than another type of mortgage that was available to you at the time you were applying. This happened with my wife and I when we applied for our mortgage in I think it was July 2016. We decided to go for a fixed rate mortgage because interest rates were low at the time, and we thought it makes sense to sort of lock in a low interest rate because we thought it was more likely to go up than to go down. However, a month after we took out that mortgage, the Bank of England's interest rate actually was cut in half, I think from 0.5% to 0.25%. If we had taken out a tracker rate mortgage as opposed to a fixed rate mortgage, we would have actually benefited from the drop in the Bank of England's interest rate. But we didn't know that at the time, and we made a decision based on the information that we had. So the last thing I want to mention on this topic is that the rate you take out with your mortgage, no matter what type of mortgage you take out, is set for a certain period. With a fixed rate mortgage, it's the exact amount that you agree at the start of the mortgage. With a tracker, it's a certain amount that you agree above, a certain percentage above the Bank of England's base rate. And with a discounted variable mortgage, it's a certain percentage below your lender's standard variable rate. This rate is only set for a certain period, usually between 2 and 10 years. When the period of your deal ends, you'll be moved from what that rate was to your lender's standard variable interest rate. Now, this interest rate is likely to be a lot higher than the amount you were paying or the percentage of your interest rate during the deal period. So it's a good idea to make sure that you prepare to move to a new mortgage or remortgage before you get to the end of this period, because if you don't, you could be paying back hundreds more a month. Ideally 3 months towards the end of your mortgage deal, you should start looking for new mortgages, getting your paperwork together so that you can apply for a new mortgage and actually agree and secure that mortgage before the term of your existing mortgage ends. Otherwise, you'll be paying more than you need to. So the last topic I want to discuss in this video is applying for a mortgage and finding a mortgage broker. Now, at the start of this video, I said that I think one of the best things you can do is find a mortgage broker. Now, this is because they do a lot of the hard work for you and can help advise you through the whole process. They will ask for all of your finances, so your bank statements, and ask you for different details. But with that information, they'll be able to advise you on how much you can afford, the different sort of mortgages available to you, and give you a better idea of what mortgages you're likely to be accepted for based on your own situation. Also, they can help you get a mortgage in principle, which is a non-binding statement from a lender saying the maximum of what they will lend you. Now, you don't necessarily need this to buy a property, but it helps sort of estate agents and people selling their properties take you more serious as a first-time buyer. It gives them more confidence that you can actually afford the property that you're trying to buy. However, there are a few key things you need to be careful of when finding a mortgage broker, because not all mortgage brokers are the same. The first thing you want to make sure is that your mortgage broker is qualified and that qualification is recognized by the Financial Conduct Authority. The second thing you want to check is that your mortgage broker actually looks for deals with all lenders. Now, some mortgage brokers are tied to a small panel of mortgage providers, mortgage lenders. So that means they won't be able to shop across the whole market to find you the best deal, and are limited to the panel or the group of mortgage lenders that they're tied to. The third thing to check is how your mortgage broker is paid. Now, some mortgage brokers, they don't make any money from you directly. All of the money they make is from the lender. Now, with this type of mortgage broker, the deals that they get you are not going to be more expensive than if you applied by yourself. The amount that you pay in application fees and the interest rate that you get will be the same even if you applied for the mortgage yourself, which is another reason why you probably shouldn't apply for these type of mortgages yourself, because the mortgage broker will do all the hard work for you and you'll still get the same deal as if you applied for it yourself. Some mortgage brokers charge you directly, and this could be a fixed fee or it could be a percentage of the mortgage you take out. Others charge you an upfront fee, but I think you should avoid any mortgage broker that's trying to charge you an upfront fee, because if you don't take out the mortgage, if you don't take out a mortgage with that mortgage broker, then you would have paid that money for nothing. So it's better to go for a deal or go for a mortgage broker where you either don't pay them at all and they make their money from the lender, or you only pay them on completion of the mortgage. Now, some mortgage brokers get paid through a combination of the different examples I gave. So some may actually make money from the lender, but may actually charge you directly as well. So the mortgage broker my wife and I used when we bought our first property made their money from the lender, and they gave us a great service. So I don't necessarily think that you need to pay a mortgage broker directly in order to get a top service, because we got a top service and we didn't pay anything to the mortgage broker directly. So don't think if you're paying directly for that service it's going to be a better service. Try and find a mortgage broker that makes their money from the lender. The next thing I'm going to talk about on this topic is finding a mortgage broker. Now, with this type of service, I think the best way to find a mortgage broker is by speaking to friends, family, and colleagues, and finding out who they used and whether they would recommend the mortgage broker that they used. Word of mouth can be the best way to actually find a mortgage broker. Also find out about like how they charge them, like what the experience was with them, and find out whether they would recommend them. The mortgage broker that we used was so good that we were happy to sort of recommend them to other people and sort of actively do that whenever we speak to someone that's buying a property. If you don't know anyone that's used a mortgage broker, or knowing your friends and family would recommend the mortgage brokers that they've worked with, then I'll leave a few search engines for brokers in the description below, and you'll be able to find one in there. Remember to ask what qualifications they hold, how they're paid, and whether they can look for deals with all lenders. The last thing I want to mention with mortgage brokers is that they're very likely to try and sell you insurance, either mortgage payment protection insurance or lifetime insurance or building insurance. Don't feel pressured or the need to actually take out one of these types of insurances with your mortgage broker. Make sure you get independent advice or you do your own research before actually taking out one of these insurances. Now, these type of insurances aren't bad things. I have life insurance, for example, but the deal or the insurance that your mortgage broker finds you or offers you is not necessarily going to be the cheapest available to you. For example, when my wife and I were buying our property, our mortgage broker offered us life insurance, but we were able to find life insurance for £10 a month cheaper than what they were offering us. If you decide after doing your own research or getting independent advice that you need insurance, make sure you shop around. I've left a few links in the description below, just giving you a few tips on how you can get good price insurance. Now that brings us to the end of this video. I hope you found it useful. This video was in response to somebody that actually asked me to make a video for first time buyers, so I hope you found it useful. If you did, please like, share, and don't forget to subscribe. Liking, sharing and subscribing to this channel helps it grow, and it helps people who might also find the video useful actually see it. So yeah, don't forget to like, share and subscribe, and I'll see you when I make my next video. Take care.